Good afternoon, everyone. Hello and welcome to the second installation in our Conservation Finance Roundtable webinar series. Today we're doing new funds, financial products, and initiatives. First and foremost, just wishing you, your families, your organizations, your communities our very best as we're all managing in pretty darn uncertain times. As we were getting prepared for today's webinar, it dawned on us that only 1 month ago we were still debating whether or not to postpone the event in Des Moines. So while the world remains entirely crazy, we are excited nonetheless to connect with everyone today. I'm Lee Welton. I'm the director of the Conservation Finance Network, and I'll be co-facilitating along with my colleagues Allegra Rockledge and Michelle Haynes. We are joined by Maggie Monast from the Environmental Defense Fund as moderator, along with Aaron Heitkamp of Pipeline Foods, Mark Lambert of Quantified Ventures, and Aaron Leonard of Mercaris. In case folks are in the audience and joining us for the first time today, this Roundtable initiative is the result of a September 2015 NRCS Conservation Innovation Grant to the Conservation Finance Network. And the purpose of that award was to provide a dynamic learning forum for learning, interaction, and continued engagement through the delivery of these roundtable meetings or virtual webinars, as the case may be for today. And so to be convened in partnership with NRCS and a range of leading practitioners through the end of this month, our hope is to reduce market barriers and increase the financial resources deployed for conservation. We put this in the email announcement for the webinar, but we are well underway with transitioning this effort beyond the auspices of the CIG funding. So stay tuned for more, but we remain entirely dedicated to continuing the Roundtable as a core CFN program. Before I hand things over to Maggie, I want to make a few quick announcements. So let's see, next slide. At 5 o'clock today, let's start with our dessert, fun stuff first. At 5 o'clock today, we're going to experiment with a roundtable reception hangout. In a nutshell, when we did the first of the 3-part series 2 weeks ago, we were so excited to see familiar faces, such a welcome sight. And so we thought we'd just give a shot to a virtual hangout of sorts. Not quite the canapes and sponsored beverages of a normal roundtable reception, but we hope to see some of you tonight at 5. Please bring an agriculturally derived beverage of your choice, as well as, you know, a sentence or two, something that you're working on. It could be a project, it could be a report, it could be your CIG project, just really anything for a work update on what's keeping you busy these days. And we'll lightly facilitate those updates and your description of your beverage of choice. If you happen to choose the thematic Zoom background, bonus points and potentially even a prize. Next slide. Also, this would have come out in the update for today as well. But we are coming to the close of the Conservation Finance Network's CIG, and we need your help evaluating the efficacy of the Roundtable initiative overall. We've gotten, I think, 3 responses so far, but really hope that in the next week we can lean on you all to share your insight, share your input, and really help us assess how effective this series of convenings have been in helping to build some common language, build some common understandings, keep folks updated on advances in the field, and generally kind of move the ball forward as we all work to pilot, develop, and scale various approaches to working lands conservation projects. Next slide. So this webinar, New Funds, Products, and Initiatives, is the second of our 3rd as we try to carry forward agenda content from the postponed Des Moines Roundtable. Please stay tuned for an announcement of the yet to be scheduled 3rd webinar in the 3-part series, which will focus on the new 2019 CIG recipient cohort. And just on a housekeeping front, we've muted everyone's lines and we've turned off your video. If you could please use chat to submit questions or comments, we'll hold your questions until the end. Michelle is going to be watching for people to raise their hands with the Zoom function, where she will then unmute your line for questions once we get to the Q&A portion. And all of these presentations will be recorded and uploaded to the CFN website, so stay tuned. We do not yet have Wayne Frederick's recording, the first webinar recording, on the website, but we do have that uploaded. So if you missed the link for that, we did send it out yesterday, but happy to share that with anyone who may find it of interest. And with that, I will hand things over to Maggie to get the ball rolling. Thanks, Maggie.
Great, thank you, Lee. Hi, everyone. I'm really excited for this discussion today. We've got 3 great panelists. First, a little bit to introduce the topic and myself. So I lead Environmental Defense Fund's agriculture finance efforts, where we're working to embed the value of conservation adoption into the decision-making and products of the mainstream farm financial system. If you want to check out any of that work, I've included a link to our website below. In the process of developing our work, we've identified several market failures or blind spots in traditional agriculture financial systems that result in negative outcomes for farmers, their financial partners, and the environment. What really excites me about today's webinar is that each of these projects are trying to solve one of those challenges. So at a high level, some of the challenges that we've seen, one are information failures, either lack of data or challenges in quantification of the real financial benefits associated with conservation adoption on farms. 2 is a mismatch between the short term and long term. So many of the practices that we're talking about sometimes have short-term costs or crop yield risks, but have real long-term benefits, either in resilience of crop yields or improving the value of the soil. And yet most of the financial structures in agriculture are set up around that annual cropping cycle. So that also creates a real short-term focus in the overall system that can create barriers to practices with longer-term benefits. And third is there's often a mismatch between the implementer of the practice, usually the farm operator, and the beneficiary of the conservation action. So that could either be a landowner in a situation where farmland is rented, which is roughly half or so, kind of depending on where you are. Or it could also be some of those broader benefits like downstream clean water or flood reduction benefits. So all of those challenges are tough to tackle. And that's why today's panel is so inspiring and gives me so much hope. And with that, I'll let each panelist introduce themselves, and then we're going to launch into the first presentation with Erin Heitkamp.
Okay, I'll go ahead and introduce myself.
Next slide.
I didn't take that cue very well. Good afternoon, everybody, and thank you to the Conservation Finance Network for having me today. This is a great discussion, great group of people doing some really innovative things, and I think you'll all find throughout the discussion that there's a lot of overlap in the approaches that we've all taken. So again, I'm with Pipeline Foods, which is an organic and specialty grain supply chain company. We're just a little over 3 years old, based in Minneapolis, Minnesota. The core components of our business are buying and selling grain, and then we own and operate midstream assets, including elevation, drying, cleaning, sorting, milling, crushing, everything that has to happen to grain from the time that it leaves the farm gate to when it either becomes an ingredient for a livestock operation or ultimately an ingredient in a food product. We are a purpose-driven company adhering to the values of integrity, sustainability, and collaboration. And the components of our business that make us really unique and really set us up to be to even have the opportunity to be part of the discussion today are the things that we do on either end of the supply chain where we don't actually have operations. So we have what we call our farm profit program, where we provide resources to growers, those that we buy from and otherwise, to support them in their transition to organic and regenerative production practices. And then on the other end, we work with food companies to get them back to the farm, to have the connectivity to the farmer and the farms, and to have visibility to how they're producing their food so that they can be part of the conservation conversation. Next. So I mentioned briefly our Farm Profit Program, which is where the project that I'm going to talk about briefly falls within the company. So the purpose, again, of this program is to provide resources to growers where they otherwise might be lacking or are just not readily available to all growers across the United States in particular. And we built this program really by first spending about a year identifying the barriers that growers face to transitioning to specifically organic production initially. We're transitioning now to look more comprehensively at regenerative production as well. What we found in that exercise was that farmers oftentimes struggled from an agronomic perspective. There weren't trusted organic agronomy experts and advisors that could support them either in starting to think about or plan transitions or ultimately as they encountered challenges. They also encountered a lot of financial challenges, which is again the focus of my comments today. We heard over and over from growers that they were experiencing that short to long-term mismatch that Maggie referenced, in that the local banker that they had historically worked with would oftentimes want to extend a typical annual operating loan, and oftentimes didn't understand the organic marketplace or trust it, and or have a product that they could offer that could help them bridge the 36-month gap between the initiation of transition to certification. And then the other barriers that we seek to address through this program are market, regulatory, and social psychological in nature. And I could talk at length about any of those, but again, I'm going to focus back in on the financial piece. Next slide, please. So there are a few different things that we have pulled together as part of addressing those financial barriers. But ultimately, the piece that I think is probably the most innovative is a transition loan product that we worked with a bank to develop. It's a little awkward to be presenting on this because we literally just signed our co-marketing agreement on Friday of last week, and I need permission from this bank to identify them using their name and logo, and we couldn't get that permission in short order. So I'm just going to refer to them more generally. What I can say is if anybody on the line wants to learn more about this bank and or the product, I'm certainly available to have a discussion after the webinar and to make a referral. In any case, the product was really developed in order to help farmers cash flow through that 36-month transition between initiation of the transition to organic certification. And so we sought out mission-aligned bank partners that really understood organic, they understood the need, they understood the opportunity for the grower, and also just recognized that they were not, up until late last year, providing solutions to growers that really met their needs. So after finding this bank, we worked with them to develop the product by launching a pilot project in February of last year. And so we recruited 6 of our growers to test the product, and then the bank refined it, and then they officially rolled out in October of 2019. Next. So high-level overview, this is kind of the meat of the offering. It is the first of its kind in the organic industry and in the banking industry. As far as we know, there was no other bank in the world that had a product like it at that time. I think since then, one other bank has launched a similar product. It gives farmers the flexibility to access that capital up front and to really manage those 36 months without too much pain and suffering and or without creating an absolute barrier to proceeding. It keeps them whole during that challenging period, and they then have some flexibility in terms of when they ultimately pay back the principal on the loan. Fundamentally, it's structured kind of like, I think of it as like a mini mortgage with interest-only payments during the first 3 years, and then the last 4 years you pay against the principal as well as that any accrued interest. The other piece of this, there's two other pieces actually that also get at that mismatch that Maggie spoke to. We heard over and over from the banks that they recognized there was a need for this offering. They also recognized that even if they created the product, there would still be growers that would struggle to meet their underwriting qualifications. And to the extent that the offering could be further de-risked, that would be appealing to them. And so this is where Pipeline steps in to further collaborate with the banks. Not only do we identify the growers who are interested and have need for the loan product, but then we also offer a long-term offtake agreement with Pipeline Foods where we guarantee that we will buy the full rotation of organic row crops on the defined acreage that's covered by the loan. The other piece of this is we will oftentimes work with the landowners as well, to the extent that the farmer is renting the land. We'll try to tie that piece together as well to work with the landowners to enter into long-term leases so that you get aligned terms across the lease, the long-term offtake agreement, and the loan period. Next. And that is it for me for now. Thank you.
Thank you so much, Erin. We are now going to move over to Erin Leonard. There we go.
Thank you. Well, thanks so much for having me, Conservation Finance Network. Super excited for the opportunity to present today. My name is also Erin Leonard with Mercaris, and we are a market data research company for the organic and non-GMO agriculture industry. So we produce a range of market data research, and over the past year, we've kind of launched into a new area, which is looking at land value for organic agriculture, which isn't something that we've looked at until now, and that's what I'm going to be talking about today. So this new initiative is called Mercoterra, and next slide. And it's an initiative to compare certified organic farmland value to comparable conventional farmland values, to look at the monetary incentive for transitioning land, for the value of the land itself, and not just the income potential of growing the organic crops. So this initial white paper is really kind of a proof of concept, looking at what is going on in this market, and if there's something there to build out a kind of more robust product around organic land values for the industry. Next slide. So for this project, we've been working with 4 partners, which are Laird Norton, People's Company, Midwestern BioAg, and the Croatan Institute. And we're really thankful to have these partners on. They've provided us with some data for this project and kind of sharing their expertise within this topic and kind of what they're seeing in the market in regards to land values. Next slide. So beyond some of the initial data that was shared with us by our partners in this project, what we found when we were looking into this is that there's really not much data out there on organic land values. So what we decided to do was put out a survey and create an original data set of landowners and operators who rent land and look at what cash rents they're paying for their organic land. So the survey that we put out was loosely based off of the National Agricultural Statistics Census survey that they do yearly of landowners across the US and farmers. So in our survey, we focus on how many acres are farmed on the land, the crop types, the details of the lease agreement, the cash rent that they paid or charged. And then we also asked a good amount of qualitative questions about people's sentiments towards organic land values, specifically as it relates to the land that they either own or operate. Next slide. So some of our initial findings. So far, we're looking at 109 observations, which represent about 56,000 organic acres in the US. And this is for basically row crop farming. And so of the respondents, about 70% farm organic acres only, and 30% farm both organic and conventional land, or maybe non-GMO. And the average lease length was almost 6 years. And in that pie chart, you can kind of see the breakdown of the respondents to the survey. The largest group of respondents both rent some land from others and own some land that they operate themselves. And then the second largest group are people who both own and operate their own land, so they're not renting or renting it out. And then the third largest group are people who rent land from others. And then the smallest group was people who own some land and rent some out to others. Next slide. So some really kind of initial findings from this survey. The average organic cash rent reported for non-irrigated land was $193 per acre. But this number is just a really kind of high level look and not broken down further geographically or by crop type or anything like that, which is something we're planning to do in the white paper that we release. So if you look at our white paper, you'll see, more accurate representation of what does that number actually mean. But another kind of really interesting finding is for that 30% of respondents who farm both organic and conventional land, a percentage of them are on paying a fixed cash rent and paying separate rates for the organic land and for the conventional land that they farm. And we found about a $70 premium for the rental of the organic land. Again, that's just for the subset of people who responded who are farming or owning both conventional and organic land. But that was something that was very interesting and kind of an initial finding so far. Next slide. So then, as I mentioned before, we were asking about people's cash rent values, but we also asked landowners and renters a lot of questions about how they feel that the markets are right now for them and their experience with their organic land and its value. So 55% of people responded that they believe that their organic land is worth more than their neighboring land that's conventionally farmed. And we asked why, and the biggest group of people just based that on the higher income potential that organic land has. And then the second largest group are looking at the soil health and the environmental benefits. And the third largest group are looking at the fact that because the land has now been transitioned to organic, it's the 3-year transition period and the costs associated with that have been covered. And so if they're to sell this land, that would present a large value for whoever was buying it if it's purchased by another organic operator or someone interested in keeping that land organic. And in these boxes, you can see actual responses that people wrote in on the survey that we put out. Next slide. And really interestingly, on the flip side, 39% of people who responded to the survey think that their land is not worth more than their neighboring conventionally farmed land. So we thought that the reasons for this were almost more interesting because it's interesting when someone who owns organic land is saying that they don't think it's valued higher. So some of the reasons for this is because people recognize that their land value is based on comp sales in the area. And if there's not a lot of organic land in that area, then when the appraiser comes and looks at their land, they're not really taking it into account. And so they feel that if they were to sell that organic land, its organic status wouldn't be taken into account and it would just be sold based on what land in the area is sold for. And as we've talked to appraisers and people in the market, we've definitely seen this reflected as a reality in some areas. And then the second reason, not enough organic operators yet, it kind of ties into that, what I just explained. And same with the land can be bought by non-organic farmers due to the location, which we've seen as well. Some organic land has gone up for sale, and then people just buy it because of its proximity to land that they already farm, and they put it back into conventional production. So I think that a lot of these answers of why people think that their land isn't worth more than conventionally farmed land kind of line up with what Maggie was saying about kind of issues or lags in the marketplace. Next slide. So for the next steps, we are kind of in the midst of doing some further analysis on the data set that I just presented to you, and even kind of building it out a little more with some further data. And we are also incorporating feedback into our study from partners and stakeholders kind of across the supply chain. And then sometime in the next few months, we don't have the release date yet, we'll be putting out this paper and kind of convening further conversations with people across the supply chain in the organic industry to look at, based on the findings in the paper, what kind of products related to land value would be helpful in the market, whether that's further research to build out a longer term data set by looking at trends year over year, or some other kind of tool that would be helpful. And that's it for me.
Thank you, Erin. Our last presenter is Mark Lambert. Take it away, Mark.
Yeah, thanks. Hey, everybody. Thanks for joining this morning, or morning for me on the West Coast. I'm Mark Lambert. I'm the director at Quantified Ventures. I lead our agriculture practice area. Quantified Ventures is an outcomes-based capital firm, and we design and structure and implement financial transactions to address environmental and social challenges. I focus on ag, as I mentioned. That's what we'll be speaking about today. We also focus on recreation, forestry, urban and coastal resilience, green infrastructure. The product we're going to talk about today is the Soil and Water Outcomes Fund, which is an initiative that's managed jointly by Quantified Ventures and the Iowa Soybean Association, which is the reason for the ISA logo here on the cover page. If you could tick to the next slide. This initiative between ISA and QV is intended to alleviate a number of problems that we feel limit the adoption of sustainable agriculture at scale. And we just heard about a couple from Erin and Erin. We're taking a similar but slightly different approach to trying to solve for some of these same problems. There's a fairly limited adoption of practices like cover crops or reduced tillage across portions of the country where we feel they would provide significant ecological and economic benefit to producers and downstream beneficiaries. And there's a handful of reasons, a few of which are on this slide, that we feel limit that adoption. There are, of course, existing federal and state cost share programs for providing financial incentives to farmers to adopt these practices. In some cases, they don't provide sufficient per acre incentives for farmers to consider adopting them in light of the somewhat challenging bureaucratic and eligibility requirements that are associated with them. Similarly, these programs can often be fragmented and, if not competitive, not perfectly complementary to each other. They may exist at the state and federal level and create confusion around which programs are the most appropriate to pay for what practices over a long-term period. Generally, there is often some, perhaps not suspicion, but perhaps lack of awareness or lack of interest in fully engaging with a publicly funded or governmentally funded program to provide the incentives that farmers would like to have in the early years to begin adoption of these programs. And these are just a few of the issues. There's obviously a number of others which the panelists, and I'm sure a number of you are aware of. If you could tick to the next slide. At the same time, there's a very large and significant and growing demand for the outcomes, the environmental outcomes associated with practices, conservation-oriented practices implemented in the agricultural landscape. Carbon obviously is one that we're quite familiar with, and for which there has been an established market in the voluntary and regulatory context for some time. Nitrogen and phosphorus relating to two elements of water quality impairment, which are increasingly a challenge for upper Mississippi River Basin and Great Lakes states, where water quality impairment causes economic damages, challenges to recreation, and requires investments really in infrastructure in some cases to be able to remove those impairments from water quality. And there's characterized or starting to be characterized demand for the value of these credits that various entities that benefit from them would effectively pay in order to achieve the results of increased carbon sequestration or removal of nitrogen and phosphorus from waterways. So in light of those challenges to adoption and kind of increasing market demands, Quantified Ventures and Iowa Soybean Association have launched the Soil and Water Outcomes Fund, which on the next slide here, we'll kind of tick through how it works. If you could advance to the next one. So the Soil and Water Outcomes Fund is really an investment vehicle. It's currently domiciled within the Iowa Soybean Association. The way that the fund works is it raises capital from a variety of both public and private impact-oriented investors. It uses that capital to provide financial incentives to farmers to adopt practices like cover crops or reduced tillage as we look forward into the next few years of implementation. We hope to be able to promote structural practices like edge of field practices or wetlands that also remove nitrate and phosphorus. For now, we're focusing on in-field practices like cover crops and reduced tillage. So the fund identifies farmers, and we work through intermediaries like agronomists or certified crop advisors to do so. We provide them with financial incentives to implement those practices. A third-party partner runs our monitoring and verification process using off-the-shelf models to quantify the carbon and water quality benefits attributable from those practices on a farm or field-by-field basis to generate the unit reductions of the outcomes that those practices create, specifically for now focused on carbon, nitrate, and phosphorus. And the fund contracts with what we call outcomes payers or customers that benefit from those credits. And there's two types, at least in this current phase of the Soil and Water Outcomes Fund, two types of customers we're working with. Large corporate agribusiness who have supply chain sustainability targets, greenhouse gas mitigation targets in their global or scope 3 supply chains. In this case, we're specifically working with Cargill, the largest privately held company in the United States, to purchase carbon outcomes from the fund's investment. And we're working with two Iowa municipal wastewater utilities at the moment to purchase the nitrate and phosphorus credits resulting from these practices, and that are then applied to Clean Water Act and BDES permits that reduce their need to invest in water infrastructure improvements at their plant. And the payments from the sale of those outcomes are returned to the fund, which allows us to repay investors or to scale up the fund's investment activity and drive more conservation onto more acres in subsequent years. So that's the general kind of process and funding flow of the fund. On the next slide, we talk a little bit about what makes this approach different or perhaps helps alleviate some of those challenges that we talked about. The goal here is really to create a for-profit and market-based system of providing financial incentives to farmers, not necessarily to wholly replace the current public approaches from NRCS EQIP, for example, or state programs, but to supplement it to get to the scale that we think is necessary to really mitigate climate change and solve for these really challenging water quality problems. What makes us feel we're sort of differentiated enough to do that? We have a really strict focus on additionality. So we're only promoting or providing incentives for practices that are new above a baseline. We feel strongly that in order to really get to that scale, it's going to take motivating those actors who have not yet been motivated to implement conservation practices off the sidelines and engage them. So we're looking for farmers and landowners that are just starting to engage in practices like this. Second, by focusing on monetizing both carbon and water and potentially other outcomes, which we could talk about in the discussion portion, for example, flood mitigation. But by stacking together those outcomes, the fund's able to provide two important things. One is higher payment rates to farmers than are typically available via existing cost share programs because we're paying for multiple outcomes of conservation practices. but we're also able to provide outcome pricing to our customers, to those agribusinesses and wastewater treatment utilities, that's more cost competitive than their alternatives if they're operating alone. Meaning we're bridging the gap between municipal utilities and agribusiness that both derive significant benefit from agricultural conservation and creating a sort of virtuous cycle on the pricing side that allows us to undercut their alternatives, which again creates a sort of profitable model. Those are the two I wanted to focus on this slide in the interest of time. On the next slide, just to give you a snapshot of where we're at with this at the moment. This year, 2020, is our first year of implementation of this vehicle. We've enrolled just about 10,000 acres in the 2 watershed areas in Iowa that you see on the right. We're focused for this year exclusively on the state of Iowa. We're working, as I mentioned, with an agronomy partner. There on the left of the slide, Northern Iowa Agronomy Partners, to enroll and identify farmers. And Sustainable Environmental Consultants is our third-party monitoring partner. They're using NTT, the nutrient tracking tool, and Comet Farm for water quality and carbon quantification, respectively. I mentioned our customers, Cargill and Iowa Municipal Wastewater Utilities, of which there are 2. You can see there the expected outcomes of that 10,000 acre or so footprint that we have for sale from this current year of implementation. This is our first year at 10,000 acres. Next year, we're expecting to expand to around 100,000 acres in the state of Iowa. And Iowa Soy and Quantified Ventures are currently working on our expansion plan for other states in the region as well, to bring this model to states where these kinds of farming systems precipitate those same environmental challenges. But in Iowa, at least, we're focused on about an order of magnitude growth next year to 100,000 acres. So with that, I'll turn it back over to Maggie.
Thank you, Mark. All right, I have a couple of questions for moderated discussion, and then we're going to be sure to save at least 10 minutes for the end. So my first question for the panelists is, what success looks like for your fund, product, or initiative? Who wants to dive in first?
This is Erin Heitkamp. I'll make a comment or two. So for this particular offering, for us, it's having made at least 3 or 4 dozen referrals to the bank, where we've got growers who are coming to us to say, hey, I heard you guys are partnering, can you get me connected? And then to see that somewhere between a 20 and 30% response rate by the bank, where they can actually fund those growers. We know that this particular product is not going to, this particular bank partner is not going to be able to meet every farmer's need. And so we continue to look for other farmers and offerings that we can bring to the table. But that's approximately the target for year 1 anyway.
Anyone else want to take a stab at that?
I can take a stab. I mean, we think about acres as one kind of easy placeholder metric for growth and expansion. And, there's cover crops is only one example of a spectrum of best management practices, but you've got something like less than 6% penetration of that practice across the eligible cropland of the country. So if you take the 1 minus that, that's a lot of acres to consider driving conservation into. And there's a fairly large upper bound. I think another interesting metric that we like to think about is the cost savings that we could potentially generate for public agencies and for ratepayers, for example, on the municipal side. If we can provide a more cost-effective option for a municipal wastewater treatment plant, for example, or a state Department of Agriculture to address water quality impairment or similar challenges, it frees up a significant amount of capital for investments in other important infrastructure or improvements that benefit the public. And I'm not sure that I could put a quantitative scale on that at the moment, but I think it's a success goal that we have, is being able to kind of reframe the way that conservation ought to be implemented to unlock those public dollars to focus on other important things. It's more of a philosophy perhaps than a metric of success, but certainly something we're driving to.
And then I think that for our project, because it's really centered around adding more information to the marketplace, and one of the challenges that we've had kind of completing this project, and even still now, is getting that data to even answer that question. So I think success for this project would really be getting a conversation started and having more people collaborate and be willing to share data that might be private to be able to answer this question better and get a more accurate look at what is going on in the markets.
Great. Okay, so for my next question, I'm hoping to harness the power of the roundtable. So I would like you to describe a challenge that you've encountered in your effort, which could either be one that you've overcome so others can learn from that, or it could be one that you're still grappling with and would like to use the Roundtable network to crowdsource some problem solving.
I think that I could jump in here because I kind of just touched on that exact thing. I think the biggest challenge for us that we've encountered is a lack of data. When we started out this project, I think we thought we could go straight to appraisers or straight to bigger organizations and use the data that was already out there on organic land values, but we found that it was just really difficult to find people willing to share or to find data that could be kind of used in a standardized way and compared to each other. So how we kind of approached that challenge was going out and creating our own data set through a survey directly to landowners and farmers. But putting out a survey has its own set of challenges in terms of the quality of the responses and just getting a good response rate in the first place, especially when you're talking about organic, which is a really small percentage of land in the first place. So I think, maybe we've solved the problem a little bit in that we did the survey, but we'd really love to kind of continue to build on that data set. So anyone on the call who has insights into organic land values and valuation kind of across the supply chain, whether you are a landowner or whether you are a land appraiser, especially, or in real estate, if you want to reach out and have further conversations about what you're seeing in the market and any data that you have in this space, that would be really helpful.
I'm going to jump in here, Mark, ahead of you. I don't know if you immediately had comments, but I think my response is very much in line with the other Erin's comments, which is that and it's going to be a reference to a challenge that we continue to encounter, not necessarily specifically with regard to the launch of the transition loan product, but just generally the challenge that we encounter around gathering data, good data that's valuable and not oftentimes shared at scale from farms, and then being able to translate it efficiently into the at scale into the form of information that the consumer of that information wants to see it in. And at the end of the day, that really requires some investment in technology, and oftentimes that technology comes at a significant cost. And so for newer, smaller scale organizations, that capital is not always very easy to come by. I would also say that many of the existing off-the-shelf technology solutions tend to not be designed for organic producers in particular. We spent a lot of time running a pilot looking at about a dozen different offerings and coming to the conclusion that none of them were a good fit or worth the investment. And so now we are building out our own data management system from which we can both gather the information, process it, analyze it, and share it. So that's the big challenge that I guess I would point to, and I'd love to hear from organizations that feel like they've cracked that nut and how they did it. But the other point I wanted to make is to, I think Erin, you were alluding to this as well. Ultimately, this is about collaboration, because unless you talk to growers who are willing to be collaborative and share that information, and they see you as a true partner, and they see the value in it for them, the availability of the information is just not going to be there. So whether you do that through direct interaction with growers or through other partners, it still requires that collaboration. And so I'll just respond to you too, Erin, and say that's something that we could maybe work on going forward as well. Because at the end of the day, if if we can tell a story to growers that one other benefit of scaling their organic production is the increase in land value, that's, depending upon the scenario, that's another compelling part of the business case.
Absolutely.
Those are great points. And I agree. Whenever we talk about challenges, data is always at the top of my list. I always try to set low expectations. And I'm always reminded just to, about the basics. And that was another thing that we found, in some of the work that we've done, is that farm record keeping is often very spotty. And so what you said, Erin, about thinking about who's going to consume the information that you're developing, whether it's the farmer themselves or a lender or, a land buyer, that's really important. And a lot of times I see analyses that are being done that don't really have a clear audience in mind. And that's a really critical part of the equation. Mark, did you want to throw out a challenge, or should I go to the next question?
I can give a quick reflection on that. I don't know if this is truly a challenge or perhaps an opportunity. It depends on what side of the aisle you sit on. Capital to scale is hugely important. That's no surprise to anybody. But providing the upfront financial incentives is the key motivator, at least as we see it, to farmers. That takes significant amount of capital to get to scale rapidly. We're working on that, so perhaps it's an opportunity as much as it is a challenge. Diversifying outcomes beyond, carbon and nitrate and phosphorus are the ones we're focused on because they're the lowest hanging fruit to monetize. There's a lot of other benefits that that result from these practices. One we'd really like to unlock is flood mitigation and the ability of a healthier soil to store water and the higher infiltration rates, and even the ability of a constructed wetland to store flood waters that provide benefits downstream. That's an area we'd really like to pivot to if possible to continue to monetize those outcomes from these practices. So it's, again, maybe as much a challenge as an opportunity, but diversifying the monetization of outcomes, I think, is critical to this work succeeding.
That's a great point. Okay, I see we have 10 minutes left, so I'm going to hand it back over to the CFN team to crowdsource some additional questions.
Turn myself back on here. I thought as Michelle is gathering some raised hands from the room, I might just do a little roundup of chat questions that came in while you all were giving some really extraordinary presentations. So first, we've got one from Mark from Ryan Smith. How long are the contracts between the buyer and seller being the farmer?
Yeah, so because we're in our first year, the contracts with the 10,000 acres worth of farms that we have now are annual contracts. You hit on an important point. As we look forward, long-term agreements with both the seller and the buyer of those outcomes are critical to this working, and particularly in light of needing to raise capital in order to make this work. So we're driving, Ryan, towards longer-term agreements. I couldn't tell you exactly what number we'll settle on. It's going to be more than a year. It's going to have to be in order for this to work. Wish I had a better answer for you, but at this first year, we're not asking folks to sign up for more than 1 year because we're really testing the mechanics as much as anything else.
Problem with muting yourself. Thanks, Mark. And just a reminder for new questions coming in, if you want to raise your hand, we'll actually unmute you to ask the question by audio. If for some reason that doesn't work, go ahead and submit it by chat, but looking to make this as interactive as we're able. So one for Aaron Heidkamp from Stephen Rivard. Does Pipeline offer working capital loans and a purchase of grain agreements to farmers only in Minnesota?
So one point of clarification, we actually don't offer the loan directly. It's a referral to the bank, and then we help you get connected and potentially qualified for the loan. And then to answer the question about the long-term offtake agreements, we offer those across the 48 contiguous United States. We are currently not buying out of Hawaii or Alaska, but across, we do buy from every state in the country, and we've got contracts available to every state in the country, again, other than Alaska and Hawaii.
All right. So just continuing on, one from Sean Penrith. Mark, what carbon methodology are you using to verify the impact for Cargill? Are those for offsets or insets?
So at this first year, again, as much of testing transaction mechanics is kind of the utility of what we're doing now. The methodology, it was kind of negotiated, let's say, between Iowa Soy, our third-party MRV partner, and Cargill. It's based on Comet Farm. We're collaborating on the level of field data collection, the soil and water quality sampling that we're doing, and the I guess transparency of the data that we're collecting. I think your point's a good one in terms of standardizing methodologies, and there was another question or comment from Nathan as well that I see around how we're using existing off-the-shelf standards or protocols, whether they be from the VCS or an AB32 protocol. I think we're working towards determining what that's going to look like. The key principle we want to maintain is that because we expect to engage with a pretty wide spectrum of potential carbon buyers, we want to sell a product with a lot of integrity and that has a standard quantification methodology, but be flexible in whether it's offsetting or insetting requirements of different entities we contract with. Cargill for now has established the process for this first year. Going forward, we'll mature that process as they scale with us as a buyer and as we bring in other buyers. So I guess there's room for maturity there. We're leaving it flexible as we try to decide, what the most cost-effective pathway is. Let's say that. But I am aware there's been a lot of work done on counting methodologies, Sean, which of course you've been a strong part of.
Thanks, Mark. One more coming your way, understanding we've probably covered Nathan's in that answer. And that's a question of scale for the watershed the utilities are buying credits in. This is from Todd Brennan. Are they closely downstream within the same watershed? Also, if so, is the size of the utility a driver for siting the project? Or is the state involved in the structure in some way, shape, or form?
We're looking at around, at least now, and look, we're only at 10,000 acres, so this is liable to change, the Huck 8 to 12 range of watershed size, and the municipal utilities we're working with are directly downstream of those watersheds. And so they're directly impacted by the practices upstream. This isn't a trading approach, it's kind of direct crediting, which is allowed in the state of Iowa, and the regulations for that are managed by the Iowa Department of Natural Resources, and so they've been engaged in that process. Part of our work has been to make sure that the munis and the state level regulators, Department of Natural Resources in this case, are agreeing on the process and practices required to credit those reductions against permits. So that's been something we've been working on in the background for more than a year to make that happen. So yes, the state is involved as well.
Thanks, Mark. We actually don't have new questions coming through, though perhaps Michelle will let us know if somebody's raising their hand and waiting here. In that case, I'm going to take host privilege as we approach the end of our hour together and just commandeer moderation from Maggie to ask the panel. Actually, Maggie, I'll put you as a respondent for this one, but I'll give you like 2 seconds from the cold call and start with Mark and Aaron. And Aaron, if you had a magic wand and could, by waving it or snapping your fingers, effectively make some barrier go away or something that you've been working on to come to fruition, what would it be and why?
Well, Mark, this might make you chuckle. The issue that I had flagged during what we call our impact team's strategic session a couple of weeks ago that I really want to try to tackle this year into next is really unlocking this issue of stacking ecosystem service payments to growers in order to really create that financial incentive that's significant enough that they're willing to deal with the hassle of having to go through years of, in some cases, years of unorganized records and deal with the hassle of going through the modeling exercises and so forth. So I knew a little bit about your business before this webinar, but I learned a little bit more and I'm excited to learn more still. You're doing some fantastic work. So you may have just unlocked or waved your magic wand on Pipeline Foods' behalf, which I'm excited about.
Yeah, if by chuckle you mean I'm going to send you an email as soon as this is over, then you're absolutely right.
Sure, that too. Maybe we can chat some more over a virtual cocktail at the farm.
Yeah. My quick response, Lee, would be really continuing to push, or I guess to magically make the shift from pay for practice to pay for outcome happen at the state and federal payer level. I'm talking NRCS, state departments of ag, shifting those large pools of funding towards at least testing approaches that are focused on paying for the outcomes of practices rather than the practices themselves, which we feel is a much more efficient allocation methodology for public capital. We're working on that, and there's been good signals even in the last Farm Bill and the new RCPP AFA, but that would be the one we would waive, I think.
Yeah, I was going to ask about the new RCPP, but I didn't want to put you on the spot with that one. Erin Leonard, you want to take a stab? Buy Maggie another minute?
I think it would be the barrier for farmers and landowners to information about what other farmers and landowners in the organic space are doing. I think that as I've talked to a lot of people, there's kind of a lot of confusion, and so that would be mine.
All right, and I'm gonna say, really maturing that quantification piece where we can get more accurate accounting of the financial benefits of conservation adoption, whether it's cost savings or risk reduction or, cost savings to somebody other than the farmer, long-term asset value of the land. I think that those are the barriers that stand in front of the other barriers, and that if we can show a compelling quantification case, then that will help us, bend down those other barriers. So we're spending a lot of time on that, and I'm sure I'll be talking with folks in the roundtable about it.
Well, incidentally, each of our panelists was queued up to speak to some element of your answer. So a nice little cohesive ending to our webinar session today. Thank you all, Maggie for moderating, Mark, Erin, and Aaron for joining us today and sharing a bit of your work, whether the new fund, the new product, the new initiative. For folks who are free at 5 p.m., do feel free to hop on over to our virtual reception. Should be fun to see folks and continue the conversation there. And then I'll just end with a plea. We've been talking about data and metrics and a lot of good related stuff today. CFN needs your help creating our own data set for the efficacy of the roundtable. So don't be surprised when you receive an inbox plea with, again, a reposted link to our survey, but that very much helps us show NRCS that this investment in the roundtable was worth their while. So with that, we will thank our panelists, thank everyone who stuck with us and joined us for session 2 today. More details coming on the 3rd and final of our Roundtable webinar series, but that's it. Thank you so much. Stay healthy, stay sane, and we'll see you soon.
Bye-bye.